Hello, class. Today we are going to go through your practice assessment task number 8. You will find the materials I used today on your eLearn website. Now, firstly, please download the question of the practice assessment 8, which is shown on your left right now, and also an answer template on the right, which I'm showing on the screen right now. Um, let's quickly go through what we have, the tabs in the practice exercise. We have a local database, which is, the important fundamental sources for you to identify the key information to input for quarter one EOQ or question one, economic ordering or unit quantity. Question two on break even profit, and also last but not least, on your capital investment, and we want to calculate all the way different kind of return using an Excel spreadsheet, rate of return, payback period, net present value, and also calculate interest rate of return. So without further ado, let's start with question 1, EOQ. Okay, so now let's have a look at our question 1 questions. And the key thing when we go through all the questions, it's really an effective reading where we look at, all the information that's given in the question and figure out the right place to plug it back in our spreadsheet. Okay, so that's why I put it side by side. On the left, you have the questions on question, and on the right, you have the answer Excel template, so that you can just plug in the information from the Word document to the Excel spreadsheet accordingly. So let's get started. Let's calculate the economic order quantity based on the information given here. So using result in quarter 2, which is this Mogul result, quarter 2 Mogul result here, okay, and calculate the EOQ for raw material 1 and raw material 2. So this column C, calculates the information for raw material 1, D for raw material 2, okay. Now, what are the key information? You should use the order cost of $100. So cost of order is $100 for material run, and then $120 for material run, and $120 for raw material 2. Yeah. So therefore, we'll put in 100 here and 120 here. What else do we have? Carrying costs are $1 to hold raw material 1 and $2 to hold raw material 2. And so therefore, you have a carrying cost of $1 for material 1 and $2 for material 2. Excellent. Let's see what else do we have here. We have purchase cost was $8 for raw material 1 and $12 for raw material 2. So unit purchase cost, which is here, we have $8 and $12. Okay. So we need to provide a total inventory cost. Provide the total inventory costs for one order when ordering the economic order quantity. Okay, so this is a bit tricky. So it's just the way they put it, but really it is when you calculate the quantity discount, it talks about here the order discount. So we might as well input the data here. So as it says in here that the order size is 2,000 for the discount, and that's for both raw material. Okay, so 2,000 here. And what's the percentage discount? A percentage of 3% for R1 and 5% for R2. There you go. So you have all this information here. So then we need to calculate using the formula that's given to you here. Okay, square root of 2 times your unit price, ordering a quantity, and C, which is your carrying cost. So we have the unit, we have the cost per order, we have the carrying cost. What haven't we achieved is the unit usage per period, which is the first line here. Okay, this refers to the raw material use unit needed for use in the production for the quarter. So let's go through the material here and see where we can find it. So let's go to, I guess, the raw material section to start with. Let's find the raw material. There we go. So there's raw material 1 and raw material 2. And the unit used in the production is 600 and 5,500 for quarter 2. Again, we're looking at quarter 2 data only, okay? So therefore, going back here, the number you use is, I suggest you to use formula when you can, which is equals to this one, and that equals to 5,500. Okay. Now, given we have the number here, wrong cell. Okay. Now, given we have the number here, all we need to do is to make sure we use the right formula, which is square root, which is SQRT, stands for square root of 2 times U, which is unit, which is C5, times O, which is the cost per unit, given $100, divided by carrying cost, which is $1. $1. So your answer will be 1095.44, 5.15, or 812. Okay? And then next, we need to calculate the total inventory cost. So this we'll need to think about, okay, so if our raw material used needed is 6,000 units, and each order quantity economic quantity order is 1,000, so the number of units would have been 6,000 divided by 1095. So similarly, that would be what you have for product number 2. So when you see the way I use Excel, by the way, you can sort of learn how I use Excel as well, how you drag the formula to the next column, and how you copy and paste the formula and values as well. So that will really help you. What you in the actual assessment age, you have plenty of time, but using the formula by dragging, by copy and pasting it properly will also avoid you from making mistakes. So, well, look, we can't really have an order of 5.47. So really, in reality, we should use we should use order 6 and 7 for argument's sake. However, for our calculation purpose, we'll continue to use the fractions here. Okay, so what should be the ordering cost? It is simply your number of order times your cost per order, right? And that would be 547.72 and $812.40. Okay, so the 6.66 order times $120 per cost per order. Now, what should then be the purchasing cost? The purchasing cost will simply be, if we think about this, it will simply be, okay, your unit used in the production times your unit cost. Okay, so that would be $48,000. Okay, and then the carrying cost. Again, this is a very tricky part. Okay, so the carrying cost we would think that is, C13, which is your per order, divided times your carrying cost, which is $1. Okay, but this is not the right answer because carrying cost is required to use average. The reason is we think about it as at the beginning of the order, you will have at the beginning of the order, you will have a a unit of 1,000 unit. The unit you're carrying is 1095 units. Assuming you sold everything by the end of the period, you will have zero. So your actual carrying cost should be an average cost, which is the beginning plus zero. This is how you think about it, right? Plus zero divided by 2 times C8. Essentially, to use the formula, it is equals to your actual amount divided by 2 times your carrying cost. Okay, again, the reason we have to divide by 2 is we want to have an average number of stock times the carrying cost. Your average number is the beginning balance plus your ending balance divided by 2. Your beginning balance is your EOQ. Your ending balance is 0. So therefore, on average, is this number plus 0 divided by 2, which is this one divided by 2. So that should be your answer. Okay. And so the total inventory cost would be a summation of all the numbers you've calculated above, which is all the costs you've calculated above, which is this one plus this one plus this one. Okay. Next, let's look at how do we calculate quantity total inventory cost after quantity discount. Okay. So number of order to have the quantity discount would be your total raw material in production divided by discount order. So every 2,000, you have a 2,000 unit order, you have a 3% discount. Okay. And then the same thing happened for the next one, which is 2.75. In reality, it's 3 orders and 3 orders. But for our calculation, we'll continue to use the fraction number. Okay. So what should be your ordering cost is pretty much exactly the same calculation, which is your cost per order of $100 times your number of order. That's 3, right? Okay, and so that's 300 and just 2.75 in the calculation. Okay, and similarly, your cost of your purchase cost would have been um, it's the same as purchase cost here, would have been your raw material order times your times the unit cost. But this time it should be noted that we have considered the discount. So instead of 100%, we now only pay 97% because we have 3% discount. Okay, so the cost is actually lowered from 48,000 to 46,560. Similarly for this one, carrying cost. Carrying cost will be This carrying cost will be the same in calculation, um, but this time is we are using a, um, you know, instead of economic order, we use the order per discount order. So we use 2,000 divided by 2 times your carrying cost. Okay, that's the same. Okay, so then what's the formula? So what's the total inventory cost? Oh, oopsie. And that's that one. Oh, okay. So they've moved the cells a little bit. This is this is a time when I say, as from a person with an audit background, you will be very careful to make sure that these numbers are all tied up so people can actually copy and paste the value down. But anyway, so we got to be careful. So there we go. It's 47. So the cost is lower if you use a discount instead of the economic order quantity. Okay, so both for raw material 1 and raw material 2 is discounted. Now, don't forget to answer the questions. Difference between EOQ and discount quality cost. So don't forget to answer this question here. Okay, so what should be the difference, as I just mentioned just now? You would do the discount, the difference between the two. Okay, so what's your discussion? So don't forget you need to answer this part when you are in the actual assessment. Don't stop by doing here, because with all that, the purpose of doing this calculation is so that you can figure out, number one, your EOQ. Number one, based on EOQ, what will be the inventory cost? In a case of discount, what will be the inventory cost? Compare the two and decide whether you will go for ordering via the EOQ amount or the discount order amount. So in here, we would say that we would probably go for the one with discount. We should use the discount order size because it's cheaper by $1,235.45, cheaper than using the EOQ quantity of 1,096 unit, 95 unit really. Okay, but you want to do an extra because you want to round up in general. Okay, so that's your answer, and please do not forget to to give your discussion. So that is your question 1. And then we'll look at your question 2. Question 2 looks at break-even analysis. So for question 2 and question 3, we have to use an Excel formula that I haven't shown you in class before. So please pay attention in our class today, and particularly this video, so that you know how to use the formula. Okay. So again, the first thing we do is comprehensive reading, which is look at what you're given here and put the information in here. Now, it's a really, really tricky part, and it will be the same for you when you do your when you do your actual assessment. Please make sure that all the numbers, I guess, except for the fixed cost, but fixed cost as well. Please make sure all these numbers here are highlighted in pink, right? They are with no formula, because the Excel function we are going to use to calculate the break-even sales unit doesn't like formula. Okay, so we must make sure that there's no formula in the red cells. So let's get started. So the chief executive, the chief financial officer want you to advise them on the percentage by which value of sales achieved in quarter 2 can fall before the business is at risk making a loss, and the number of unit that it can be sold in break even. Technically, we are looking for break even number and the margin of safety. If you remember the margin of safety, right? We've discussed that in one of our classes. It basically means that what's the percentage of sale you can drop before I make a loss. Okay, so that's your safety net, and that's why it's called margin of safety. Okay, so to provide this information, you should calculate the contribution margin ratio Again, as I mentioned to you, in exam, you'll be given, in the quiz, you'll be given all the formula. But the key thing is you have to get the right number so you can apply for formula, right? So let's not get too excited. And so break even revenue, also the margin of safety percentage, and use the quarter two data for your calculation. Assume the sales mix stay the same as the quarter two. Okay, so why don't we start by one? Okay, well, to start with, I reckon we can put in the formula before plugging in the number. Okay, so the sales number here, the formula would be, you won't have the number here, but you will see the formula would be your sales total minus your variable cost divided by your sales. Okay, that's your formula. So I think first thing first, let's put in your formula so we know where we are heading. Okay, and then we also have this one, which again, you see that, these are just formula telling you using the actual sales unit minus the break-even sales unit, and then you have the divided by actual sales unit. You don't have the break-even sales unit yet, okay? So this will not make sense until we do the formula. But let's put all until we do the Excel calculation using a function. But let's just make sure that let's just make sure that we put in the formula first, so we know what to do. Okay. Now, firstly, let's look at what we have. All manufacturing costs are variable. These are fixed. Okay, so selling, admin, warehouse, and internet are fixed. So we'll get to that when we calculate this information. So firstly, um, original units sold. Okay, so where can I get this number? So obviously, we will go to our Mogul data first. Okay. And then we'll find the sales figure. The sales figure is generally in Mogul is the top, is in the top, I guess, sections. Okay, so actual demand. Demand is for product one is 5774. Let's use another color. Product two is 5044. So we'll copy these two actual demand in here. Pay special. We'll do value only, and we'll transpose the number. It's a merge cell, of course. Let's do paste value. So this value will go in. So try to just use paste value, because try to avoid erasing the color, because remember I said the color actually really matters in our case here, because it highlights to you which are the cells that you must use hard code number. Okay, done. Okay, then we need to calculate the ratio. So be careful. This is a cell that is kind of hidden, but you need to do it, okay? So this is equals to divided by here. So product 1 to product 2 ratio is 1 to 0.87. And the total would be equals to, obviously, this one, product 1 plus product 2. 10,818 units sold. Great. So next, let's look at the sales unit. We know the sales unit here is just repeating what we have, right? Repeating what we have right now. The reason we have this is because we will have to use this cell to calculate the break-even sales unit. For now, we put in 5774. And the tricky part is here, I want you to use a formula instead of a number, because when you do the function, it needs to be able to calculate the differences. So you have to learn it for now. So because if we use this template, will be largely similar to your exam, to your actual test. So just remember what we've done here. Pink sections we need to use, pink cells we want to have, hard code number. White cells we can use, we need to use formula. Okay, so that's the formula. You have the same number here. This number is going to change, okay? And then we will just copy and paste this formula in, okay? And the next thing we know is we will put in sales price. So the sales price, I think I've seen something just in when I go through this just now. The price is 63.49. Okay, so we'll copy this number here. We'll go back to here. Let's just paste in the cell again. Please use value only because we really just want value only. So this one is for product 1, value only. This one is for product 2 and value only. Excellent. And then what's next? Remember we're just plugging in the number and do the formula calculation, right? Then we do variable cost. So again, let's go back to variable cost of 37 some. I think I've seen it somewhere. Let's have a look. So then in the cost of goods sold, then where we need to go is you want to use a cost, right? So you have to go to cost of goods sold. Have I missed the cost of goods sold? There we go. So in the cost of goods sold section of your Mogul report, you should be able to see your unit cost, which is $37.44. So we'll just copy and paste these two number. Yeah. We'll put that in here. So at this stage, really, you might find it a little bit confusing, but the very essence what we're doing is to go to different source of data and figure out, plug in the right number so we can do the calculation, right? So sales unit to total sales price would be equals to your unit sales, your sales unit times your sales balance. Yes, that's correct. And this will be equals to your this one times your actual units cost. I think we can just copy and paste this value here and it will be the same. And if we do it here, it will be, oh no, we can't use it that way because I think the formula is a bit funny. So, okay, so because there's a merge cells, etc. So let's don't use the merge because of the merge cells. So we can't. We just calculate the summation between these two will be the total balances. Now we need to calculate the contribution margin. So by definition, the contribution margin will be equals to your sales minus your variable cost. By now, we should be quite familiar with the concept. So we'll have this familiar with that, which is your sales price less your variable cost, and I guess it will be the same if we actually no, because we need to figure out sales. It will be 5774. I think this may work. Yep, this may work unless it doesn't. Let's have a look. 5445. Of course, because I haven't calculated this properly. So the difference cannot be $25 here. Like, what did I do? B16. Oh, so it's B16. No, it's D16. Okay, so that's D16. Okay, right. So you got to be very careful. Oh, I thought I just copy and paste. Wouldn't it be wrong? It should be right, right? Anyway, so once I fix this number, our total number will be the same. And we can just drag it down and have this total column here. Now, fixed cost is something that we need to see where we get it from. It's a bit tricky. It's hidden in the line here. The fixed cost is selling and admin, warehouse, and interest. So therefore, you will go to our page here and we'll then figure out in, say, the cost here, cost of goods sold summary. We don't have that. Income statement, we have that. So enlighten me again, and selling and admin, warehouse, and interest. So selling and admin will be this balance here. Warehouse is the next one. And which one is the interest? Is this one. Okay. So let's copy this, go to this page, and paste the value in here. Okay. This will be, the summation of this will be 123,331. Okay. Because we need to have a uh, fixed price, so we just put it in here. Sorry, hard-coded balance. Okay, so then the profit, what would the profit be? The profit would just be obviously uh, your contribution margin, take away your fixed cost, because contribution margin equals to your sales. So technically it's sales less variable cost and less fixed cost, but that's also contribution margin less fixed cost, which then equals to 169 minus 123, 46. Okay. Right. Now it's everything sort of makes sense right now, and we couldn't do the margin of safety yet. Okay. So the next part, let's save this document for now. Keep saving, because the last thing you want to do is you forgot to save, at some point your computer crash, things happens, right? So make sure you save diligently. So now the last part of this is we need to calculate the margin of safety. Okay. So how do we calculate that? Firstly, you you haven't learned this before, so this is the first time you see it, so pay attention to what I'm doing next. So you first move a copy. Remember to create a copy. Okay. So you move this copy to move to before your question 3. Okay. So I will say this as what we call after goal seek. Now I'm going to show you what is goal seek. So in here, the goal seek is you go to the function is you have to find this function to start with. You go to data, something called what if analysis, and you choose goal seek. The concept is at break even, our profit will equal to 0. The sales to change is just sales. The sales to change is just sales unit. So what should be my break even sales unit? Okay, let's do this. Enter. Okay. So from here, they calculate your break-even sales unit is 4,196. And now you appreciate why we need the 87%, because then you can, because it's actually really calculating this one here. And so you can use the formula to calculate the rest. And the key thing, the reason that we use the what if analysis instead of, trying to fix this, it's really by trial and error. You got to change a lot of numbers, like change the cells to say to start, because say for example, you go 5,700. What if 5,000? Okay, still positive. What if 4,000? The unit is 4,000. It's negative. So there's a lot of trial and error for you to come up with the number, but the Excel spreadsheet is able to calculate the sales unit at break even for you. So at break even, so at the profit is 0. If your actual sales unit is $4,196.90, 90, it's a strange one. So yeah, up and down, like rounded by, in reality it's 4,197. Your profit will be 0, and you have a safety margin of percentage of 27.3%. That is, the sales will drop by 27.3%, before you make a loss. So it's not too bad at all. Okay. So now that's your question 2, and let's move on to question 3, which is capital investment techniques. This is really, really quite hard, so I appreciate your attention. Okay. So again, the key thing is for us to plug in the number. Let's look at the question. Your business is considering upgrading some plants. So you're upgrading some plants. You need to consider which options and what costs involved. Evaluate the options using the full capital investment techniques. We sort of talk about we talk about it in the when going through our textbooks, right? Accounting rate of return, payback period, net present value, internal rate of return. So let's look at all this rate of return by using our Excel spreadsheet. And in reality, in practice, this is really how accountants or people in the business actually do this. So it would be if one day you have to do an investment consideration, like this would be a template that you probably will come across, and then you'll be like, oh, I know what to do. I've learned it before. Okay, so option number 1 and option number 2. Okay, let's put in all this detail for now. You don't have much detail to put in, but then, there's a lot of calculation involved. Let's put in all the necessary details first, okay? Data. So the cost will be the same as the written down value of the existing plant. Okay, so the new plant will have an economic life of 5 years. So therefore, I will go here. I know it's depreciation over 5 years. Okay, and I'll go, and then we'll go calculate the depreciation. We'll do the profit 2, 3, 4, 5 years. Okay. Now, and what's next is the residual value is $40,000. So therefore, you have a residual line here. Your residual balance would be $40,000. Okay, that's your residual balance, I think. Yep, that's correct. And the cost of the plant, how much is the cost of the plant? Let's come back to it. Okay, so cost of capital is 10%. So let's put it somewhere. Let's put the cost of capital here as 10%. Okay, now the annual after tax profit. So let's put in the after tax profit, 30, which is year 1, 2, 3, 4, 5 listed here. So let's type it in as $35,000, $25,000. You just have to be very patient. $1,000, $75,000, and 1,000, $100,000. Okay, so what we are missing now is the actual plant value. And so where do you get this information? We get this information from our Mogul data. So let's look for Control F, PLANT. Ah, am I that lucky? No, property plant. You want new plants. Plant. Yep, I think that's the one. Plant and equipment. But you want a net plant. You want to do after depreciation. Okay, so the tricky one is you might see this one, but your actual one you need is the net plant. Okay, for the argument's sake, we need net plant. Okay, so you need this balance here. Let's do another color, blue. Okay, for this investment. Okay, so the plant actually produced both 1 and 2 anyway, so that's okay. Okay, so the value would be equals to, what did we have here? 529560. Okay, excellent. Okay, so what's the option 2? Let's have a look at the other one. Option 2. Retiring existing plant and purchase new plant, 20% more than the written down value of the existing plant. Okay. Mm. Okay. So the written down value after the plant itself is okay. So this one it says the written down value, which is obviously the net plant, which is the plant and equipment and written down, which is equals to 529560. But what they say is 20% more than the written down value. So it would be equals the value of the cost at new will be equals to 529560 times 1.2. Okay, that's 635,473. Be patient with me. So let's keep going. And then the next one is the new plant with 10 years of life. So accumulated depreciation for 10 years. And therefore, you will have, your 1, 2, 3, 4, 5 years, 6, 7, 8, 9, 10. We'll have, uh, we'll do it. This one, wrong cell. 6, 7, 8, 9, 10. Okay, so 10 years. What's the residual value? Does it say the incident? New plant's economic life of 10 years, no residual value. Residual value equals to 0. Depreciation is calculated straight line. Now that's easy. When you have 0 depreciation, your annual depreciation is simply equals, and straight line depreciation for 10 years will be equals to 63,56547. Okay. Annual tax profit for the new plant every year is 50 grand. So we have $50,000, and that's to copy across the next 10 years. Whew, have we finished reading the information? Not yet. Cost of capital is the same as 10%. So we'll just put it using the cell here. So this cost of capital works for both option 1 and option 2. Okay. For each of the valuation method, decide which investment will be preferred preferred mutually exclusive choices. So either choose 1 or 2. You can't have 1 and 2. Okay. Okay. So these are all the information provided in the question. The next thing is then we will use this template to calculate all the necessary rate of returns. So first one, given the formula average profit divided by average investment equals to accounting rate of return. Okay, so let's calculate the average profit, which is equals to the summation of all the profit divided by 5. Summation of this divided by 5, average is $58,000, and the average investment will be equals to your investment, beginning investment plus and residual value investment divided by 2. This is a similar concept of the inventory carrying cost, isn't it? So basically, it's your beginning balance plus your ending balance divided by 2. That's your average investment cost. What about this one? It will be similar. You will do average is simple because every year you have $50,000, so you have $50,000 at the same as well. And then average investment would be again is the beginning balance plus end of balance divided by 2, and that will be 317,736. Okay, so then what is your, this is bad. Hopefully in the exam, all these cells will be very clearly identified for you. Okay, but at the end of the day, what we need to do is to calculate the accounting rate of return using the formula. And this is 24% and this is 15.7%. Don't forget, you need to answer a question here, which is hidden, which is bad because I think what we need to do is to paste the format. So what I can do is I can sort of see whether I can paste format here. pay special formats only. Okay, doesn't really help. Okay, to answer this question, do not forget to answer this question, because fundamentally that's what we're looking for, which is, to decide whether we want to do option one or option two. The answer is whichever higher, so it will be option one, because your accounting rate of return is higher for option one than option two. Well, let's look at the payback period to see if they entitled to the same payback period. Who's gonna get payback faster? Okay, so for the 5 years for option one, our profit, which we've already determined here, which is this one. We've calculated a depreciation as well, have we? The annual depreciation, no, we haven't. Okay, so how would the annual depreciation be calculated? Depreciation, that's something I missed out. Depreciation is calculated on a straight line basis. So therefore, it will be equals to your original value less your um, residual value divided by 5 years. And hopefully I'm right. And the balance is 97,912. So your depreciation will be the same for every year. Let's type this straight because it's straight line. So your cash flow, this is a tricky part, okay? Because depreciation is itself a non-cash balance. So for you to calculate the cash flow, you need to add back your depreciation portion, because we need to see how long you can actually get the money cash back. Okay, so you will do the same here. Okay, and what is the accumulative cash flow? Obviously, this is first year. Second year will be this one plus the second year, so on and so forth. And your accumulative cash flow will be 7979560 by end of the period. Now let's do something similar for our calculation here for option two. Okay, so for option two, you have your profits. The profit is $50,000 every year for 10 years. Depreciation is straight line, $63,000 here. Okay, values only. My apology, values only. Now, cash flow, we talk about this. We want the two formula. We want to add back the non-cash component to actual cash to get the actual cash flow. So that is your actual cash flow, or like every year similar. And your cumulative cash flow will be similar as well, which is equals to this one plus this one is this one plus this one. It's accumulative. Okay. Ah, something's not right. Okay. Yep. So we got to be careful. Okay. So at the end you have 1135 in the 10 years time, but that doesn't mean you should choose option two, right? The key is we're looking at payback period. How long do we get to get the money back? The faster, the better. Okay. So now think about it. The cost of new plant. The cost of new plant, we know the cost of new plant is the same as the return value here. Okay. Left after year into year. So, okay, so the investment of 529560. So it's in between third year and fourth year. See, 529 for us to get the investment back in between third year and fourth year. Okay, so left after third year into the fourth year. So how many months into fourth year? So it will be equals to, so how much the amount left? It will be equals to this balance less, which is actually, I think it's easier to use that balance, but it's the same. It's equals to this balance minus at year 3. At year 3, you still have 120 left. So what's the cash flow for year 4 is 172. So therefore, if I think about the proportion into the month, into the 4th year for the remaining balance that has to be paid off will be 69%. So 60, about 75, 70%, about 70% into the 4th year, you have a you've got to pay back. So in a month term, it's equals to times 12 months. Okay, so that's 3 years and 8.38 months, you get the money back. So your payback period is 3 years times 8.3829 months. We'll think about it as 9 months, whatever, right? We can do it 9 months to make it easier for you. Okay, and for here, similarly, what we need to do is we figure out the cost of the plant, which is what we've calculated here. And 635472, let's look at the balance here. 635472, it will be between the 5th and the 6th years. Okay, so in the 5th year, how much have left? In the 5th year, so that one minus the 5th year, so it's 67,000 left, right? And this one will equals to in a period, this one in the 6 years of a cash flow, that will be about 59% in the month, and in a month term it will be this one times 12, and therefore your payback period is 5 years and 8 months. Let's round up. So what will be your option? Again, you would choose option 1 because our fundamental principle is whichever one that gives you a payback period first. Net present value. Now we're introducing net present value, and we're going to use the net present value factor is calculated by this formula. As I told you, it will be given to you, okay? So let's just put in the formula first, okay? Okay, you might not see anything right now, but the formula is equals to your 1 divided by 1 plus your cost of capital, which is at E5, that's 10%, time to the power of the period, which is 1 year, 2 year, 3 year, 4th year. Okay, and so this is the formula here. I think this one, they're missing a bracket here, and then it will make sense. That's the factor. But anyway, it's an open book test, so I guess just in your AT, when you do your AT8, make sure that you follow the sort of similar formula we have here, okay? Now let's do the cash flow. So 1, 2, 3, 4, 5 years, yes, we have that. Oh, 1, 2, 3, 4, 5 years. Profit, depreciation, why don't we just copy this information in here? Okay. Now, I have a cell here. When you calculate net present value, you don't forget the residual value. Okay, so thank you, Stephanie. I haven't met Stephanie myself, but in which case, we will have to put in the residual value of 40 grand, which let me do an equal sign here. You see the 40 grand here? That's the residual value. On the other side will be 0 because there's no residual value. And then you don't have any more depreciation, but your cash flow will you still have a cash flow of a profit of receipt. If you sell your product at the end of the period, you have $40,000 profit and you have 40,000 cash flow. Okay, so your PV is simply equals to your cash flow times your times your NPV factor. Okay, so it will simply be equals to these two multiply of these two. Okay, done. And so next thing we need to look at is very similar. We have 10 years. Okay, the spreadsheet is making it very different for you, but doesn't matter. We'll do A53. You don't do A50. Yep, we'll do the same. It's still the same factor, so we'll still do the same factors here. And we'll calculate the factor all the way to 10 years. Ah, we can't do A53. We have to do G53. Is it G or H? H53. And then, yep, and then we have all the way discount. The discount factor up to 10 years is 38%. Okay. So then what is your present value? Your present value factor would be a summation of all that, all of the above. Technically, we need to minus 1, which is 62 only. But look, in the exam, I'm just do the whole thing because it's 0 in the end, okay? So what is your annual cash flow? We know our annual cash flow every year is the same, and we've calculated from here. And therefore, your annual cash flow times your current factor will then give you your sorry, this one, your total net present value of your investment. Okay, excellent. I think we should. I think I should do it here instead. Just give it one cell so we can. It's easier for you to read. That's all. Okay. Yep. It's 0. No, the net cost would be equals to your annual cash flow times. Because the formula got wrong. So 697, 698. Okay. And then therefore your less cost, and what is the cost of your investment? We have to go back to our data that we imputed at the very beginning, which is 435. Yep. Okay. Good. So in which case, your net present value, let the cost, will be your net present value of, of your investment gain would be this one, net present value minus this one, 622,266. Now let's do the similar thing for option 1. Okay, so present value of the cash flow is equals to the summation of your column F. Okay. Yep. So the cost, and we know the original cost is 529560. Yes. And therefore your NPV of the investment gain would be this one minus your cost. And it will be $73,560. So which option again? Again, we'll choose, despite the total value is higher, we'll choose net present value gain better, which is which is option 1. Okay, we're finally at the very last part of AT8. Let's keep going, okay? So now we have another, we're repeating to tell you that, the net present value factors is calculated by this one. So I think we should just copy and paste the information in here. At least these values in here first. Now it's a little bit tricky, okay? The reason it's a little bit tricky here is we are going to use a goal-seek function to calculate the internal rate of return. And the goal-seek function has a little bit of tricky part here, which is it likes to recognize using, it needs to recognize using the rate of return in the formula. So this is a tricky part. This is not the internal rate of return, but for this exercise, you will put 10% in this file first. Because in the end, we'll change this 10% into, if we have to break even, what should be the internal rate of return. This number will change, okay? So let's calculate the net present value. So here's the net present value here. We have a formula, we'll do the same formula, which we'll copy and paste down, but this time we've got to be very careful. We'll use 875. Well, we'll just update all the necessary lines, but make sure we do not use E5 anymore. Instead, we use F91, and make sure you give it a $sign. So every single one will use the same one. I must have copied it wrong. That should be 40 grand. Okay. Because I was using formula. So you got to be very careful with all your formulas. Okay. So make sure you have all these numbers. Like these have to be the same as the other one. The key part is I need you to make sure that I need you to make sure that we don't actually for this one, the last year, because we sold at the 6 years, so we'll use the same factors here. Okay. So these two factors will be the same, just so you know. Just a reminder that on the 6 years, we sold it at the beginning of the year, and therefore we consider that as a residual value as soon as we depreciate everything, we finished it, we sold it, and therefore our MPV factor is the same. And this is a tricky part, really tricky. So do not drag your formula down one line. Instead, you use equals to 62. Okay. Right, so we have that. And remember the tricky part here is, again, I just have to say this again. You actually use the internal rate of return of 10% here. Okay. Because it's by the function we need to do that, because what we need to do is we need to say what is the internal rate of return. Should we want the MPV equals to 0? Okay, right. Okay, so I think similarly we do the same thing here. We put in year 1 2 3 4 5 6 7 8 9 10. Okay, we put in 10 here. We follow the calculation again, but this time, obviously, we will have to move around a few things. Make sure when you move around a few things, you just, you have to know which line it is. So to the power of that one. Yep, 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 yep. I think that's the formula. Okay. So for 10 years, net present value, oh, wrong. It's this one. Okay, so we've got that one. Your annual cash flow is the same as the above. It will be the total value equals to this one times this one, 6144. So far, everything will look just like the above, but it's all going to be changed in no time, okay? So, and what else do we need? Less cost. And the cost um, is the beginning, which is the same as this one. And therefore, the difference would be MPV, this one minus this one. What have I done? Okay, what have I done? Okay, so I think I got the wrong button. I want to have less. Yep, so it's easy for you to read. I think we're missing this part here. We know that the cash flow will be 603. One to the present value we're missing here, which equals to cash flow times your present value here, present value, net present value vector. Okay, and so your summation will be, yep, that balance here, less your original cost of 529560, and the MPV would be the difference between the two. Okay, so now let's calculate the actual internal rate of return. So basically what we're saying is what is the internal rate of return if our investment is break even, so which means our MPV equals to 0. Okay, so what we'll do is this, you haven't learned this before, and pay attention to this. Okay, so right click, move a copy. What did we do? Just similar to last time, create a copy. This time move to the end. Remember to click create a copy. Okay, okay, now before I forget, let me save the work I've done. um, and that's really important in case you lose anything in your exam. So after, let's rename it to after go seek. Okay, so now let's try to do the calculation. Again, you go to data, you look for what if analysis, and you choose go seek. And what we're setting the value is what if our MPV equals to 0, and what will be our internal rate of return. That's for product one only. Let's click it. And the internal rate of return will be 14%. Okay. Um, okay, we gotta be careful. Okay, we gotta be careful. See the formula here all changes. That's largely because my factors um changed. So we gotta be careful. So let's see what happened. Because I used that one. So instead of F91, I need to use K91. So whatever mistake I'm having right now, it would be similar to you, right? So now you can double check. It should be the same as this one. So 90, 0.9090909. Yep, that's correct. Because what we then need to do is do an option 2. Okay, let's double check our balances are okay. 113, 113, 697. Yep, yep, yep. So that all makes sense. So now we'll do one for product 2. So we'll go, so option 2, we'll go what if analysis, go seek. And then we'll say MPV equals to 0, and changing cell is the rate of return. And let's see what's our rate of return. So our updated rate of return should be 12%, 12.2%. So basically what we are saying is our MPV will be 0 if our internal rate of return is 14.8% for option 1 and 12.2% on option 2. Now then again, I just wanna highlight to you that, it's the reason we use computer to do that is because it's actually a huge trial of error exercise. They try they try percentage of 13%, 15%, 12% to see whether how can what percentage will give this balance a 0. Okay. Um, and um, and and therefore the rate of return is, that's um That's how it's calculated. Okay, that's why you use computer. It does all the trial and error calculation for you. And you again would choose option one because it brings you a higher return. Okay, so that's pretty much it. So what we're saying here is, by looking at different rate of return, based on the numbers we're given in the questions, we were able to decide which option of investment we go for in a mutually exclusive environment. So it's either option one and option two. I'm going to open. I think that concludes um, our AT, our practice assessment 8 um, uh, exercise today. All right. Thank you very much for your attention. All the best.